G'day traders, Stacey Burke from Stacey Burke Trading, and today I'm just going to review some of the simple things that I look for on the 1 hour charts, but putting it together sort of in a step-by-step format just to give you an idea of taking these basic concepts and putting them together and hopefully maybe making a bit more sense so that you can have one of the things I talk about on a daily basis is duplication and simplicity. Now, one of the things that I have really focused and honed in on with my trading in my hourly or my daily system is basically they're essentially the same thing. I look for, on the hourly system, I look for the Asia close London open to present with me some levels of support and resistance that I can find a range to then look for either a signal, buy signal, a sell signal, and that could be a breakout, that could be a resume of trend signal. But essentially I just look to try and keep things very simple. I talk about not trading on Monday. We'll talk about that in a second with the opening range. It's not always the case. I may look for trades depending on how Friday and Monday trade in relation to each other. But essentially one of the things that I really want to hone in on today is regarding catching the big moves. In order to catch these big moves, you have to be able to either be positioned into the market before it moves, or position yourself in the market after there's been a breakout. And many large trends will often take off but have moved around enough to fake out most traders, and once the market has already established the trend, it looks simple. So you've got to have some very basic fundamental approaches that are robust enough to either catch moves back, mean reversion back towards the median, or catch the breaks when they come and be positioned into strong moves. So one of the three primary types of behaviors that markets have is that, number one, price breaks out, it retests a range, it will fill more orders and then continue. The second option that we have is that it will break out, retest, fail to hold that breakout, and reverse the range. That's often what's referred to as a false break, or a marginal new high, marginal new low. The third type of situation that markets will present with is that price will break, it'll retest, it'll fail, and then go sideways into a trading range. Now, one of the things that I look for during the hourly session is that I'm very specific, looking at the Asia close, the London open, the New York open, and the London close. Now, because of my time zone location, I'm in Perth. I don't often stay up, so if I don't have a fairly often if there hasn't been a simple signal during the Asia close London open, then I most likely will be looking for that at the New York open. But if it hasn't happened around the 8 or 9 a.m. New York candles, I'll just go to bed. I'm quite happy. I'm not there to try and hit every trade, but I do see a consistency that those market opens will definitely usually often provide me very straightforward options into positioning myself with a low risk entry into the market. So if we look at last week's British pound, this is Monday, and again, as I said, I don't normally trade Monday. So let's just forget about what happened the previous week. But I will look, as Tuesday opens up, I want to be able to identify a range. So the first thing I will do is I will draw the high and the low from the previous day, or the most recent high and the most recent low from the previous day. So in this case, as Asia opens up in the morning and starts trading, it doesn't violate the low at any point during the day. But as we get into the Asia close, we have a breakout candle that occurs here. Now, aggressive traders may have traded that breakout from that early entry at Asia close. The second component of that is that as London opens, breakout traders may have positioned themselves And at that point, they may have looked to have drawn a range off the high of the last breakout candle. Now, the reason why this is important is that as Asia closes and London's opening, at this point we do indeed have a range. The market has yet to violate the low. Now the bear traders may be looking for this to violate and follow through. Now, once this bear candle has failed at the London Open, breakout traders now have a valid opportunity to look for a two-legged move, at least to possibly test the high of the range. So there's an opportunity here to trade with a one-bar stop back through to the top of that range. Now, once this large bull candle has cleared, there's other opportunities for traders to position themselves in the market at the close of that candle, somewhere in here. With one of the things you have to remember is that trends can begin as breakouts of ranges. And so if you were hypothesizing that the market may trade back up to the top of this range, you have to be willing at some point to take a position in the market, because you may not get the pullback. And often a strong trend will not pull back, and you don't know that if it is going to pull back or not. So you need to be able to identify a rectangular area with at least, I would say, 8 to 12 hours of trading. Now, if traders have positioned themselves in the market, what they may at this point want to decide to do is either take a smaller position or identify a point in the range that would be their maximum stop. So since this is a much larger candle than normal, I would use 1 ATR as my normal stop. So what's 1 ATR? You can go back and look at any of these average range bars, and one of those would probably be sufficient. 50%. Depends what you're comfortable with. But the most important thing to remember is that if you don't position yourself into this range, one of the things that I would be looking for at this point is at the New York Open, if the market has given me a pullback. Now, the second hour, first hour into the second hour of trading of New York, the market does give a pullback. So early U.S. Traders may want to position themselves long, looking for a second leg to retest that high. Now, what we saw happen at the end of the U.S. session was indeed it hit the breakout low of the range from the Monday, which would have been the lope trade, which was the low of the high period. So again, just looking to keep this simple. We'll go back here in a second and we'll look at now the Wednesday. So we've now indeed had a breakout. So what we will do at this point on Wednesday morning is I will draw a line on that breakout candle, and I will also draw a line at the breakout of the range of that candle. And the reason why that's important is that, again, we want to know at this point the market is bullish. We've had a breakout of the range. We have yet to hit the highs of Monday's high. The market opens up and auctions down. So our order flow, as we see at the US close, is down. We've had a weak follow through on the bull candles. Now we've had a breakout, a bearish breakout down, a 1 bar bull candle on the Asia Open, and then bearish activity down. Now we've had the bulls come back into the market, but at this point we have established that we're getting lower lows and lower highs. And again, the market as Asia closes is still fairly bearish. We get a double, what may appear to be a double bottom. The market trades back up on the London Open with a bullish candle and immediately reverses with a bear candle, trapping these bulls into at a loss down towards the breakout level. The gap from Tuesday's breakout is now filled. Again, no trade signals. So we see the market into the US Open have a bullish breakout. Now again, at this point, the only thing that you could possibly do with any degree of safety is either be long with a stop below the original breakout bar from Tuesday, or if you were going to short this market, a stop with above the bearish high candle from the breakout at London Open on Wednesday. Now again, at this point, this bullish breakout is still valid as we have not taken out these stops. So at this point, again, we've seen the breakout, and now the market has done what we said in one of those first three options. It has broken, it's retest, it's failed, and now, by all appearances, has gone into a trading range. During the US session, that market now closes up and has taken out the high from the London high breakout, the bearish breakdown. So now as the US session closes, we're up near these highs, and we've got these tease breaks that Bob Vollman talks about. And so again, Monday's high is still intact. The third hour of Asia trading of the 24-hour market, again, we get another tease break. We've had a breakout and a consolidation into a sideways range. As Asia closes, we see the market move higher highs, higher lows off of that breakout just before the Asian close. And again, now a bear candle pin bar that would have definitely trapped shorts into the market. Now that reversal off the London Open. So now remember, there's a few things we want to talk about. We talk about that between 2 a.m. and 5 a.m. New York, the market will often consistently establish a high or a low for the session. Now, one of the other things that we talk about is that the opening range, Monday to Tuesday, 80% of the time or greater, we will often see the high of one of those 2 days or the low of one of those 2 days establish itself as a selling range high for the week or a buying range low for the week. At this point now, we've established that the low of Tuesday has held, the low of Monday and Tuesday has held. Now we're testing the highs of Monday, Tuesday, which at this point we had a range-bound market. As Thursday opens up, we've now pushed higher, and now we also are seeing what you could call, I'll just draw a little ellipse in here, possibly if I can draw this properly. Oops. I'll try that again. But a squeeze play. So we've got this building pressure. Having trouble drawing that here. Try again. Oh, this will have to work. We're getting this building pressure that's coming into the market inside the moving average and below the highs. So this, we could have either a big failure coming up, but again, shorts who traded this market, so even if you shorted this market, you had a 1-bar stop above the bearish pin bar. Okay, as soon as this bull candle closes, you would have to exit that trade and be ready to go long. And the reason why that is that we've got all this pressure building up into the market where we've already had these tease break highs, and as soon as we and as we witness this is exactly what the squeeze play should do. It explodes out, and now we've got bulls jumping on board. We've got these bear stops that have been hit, and so it's accelerated the momentum up. But again, all of this is again, if you look at these basic highs and lows and rectangular patterns, so if we go back and we just clear this out again one more time, be able to draw some patterns. So even if we took the Asia high and we took the Asia low, which at this point was here, we had a breakout in Asia. I'll just draw that a little bit better. We had a breakout in Asia. So now we want to draw that high. Okay, so again, you can see a rectangular range. The market drew people up. Shorts thought they were going to get a short trade out of this. We had another level from Monday. We had another level from Tuesday that the market is now clearly traded through with higher highs and higher lows. Bulls were able to position themselves again at the close of that candle with a 1-bar stop. And again, we're looking at an asymmetrical risk to reward. Now what's important about this is if we clear this out one more time, we want to draw a range. So, two things we want to do. Let's look at the range so far from the week. We want to look at the high and the low. We should be able to replicate that range now with movement. That gives you an idea of what your asymmetrical risk reward may be with your trade. Now again, if you're going to go for 1-to-1, 2-to-1, that's great, but when you have the opportunity to maybe to go for 3, 4, or 5-to-1, it's important that you start identifying these ranges to know once a market breaks out and you've got this coiling pressure, and you can even go back and start looking at your weekly ATR to establish what's the average range of movement for whatever particular instrument you're trading for the week. Because once it breaks out of this range, and that may happen on the Tuesday, but you've got to start looking at where the asymmetrical risk rewards are. So again, now what we do is we go into Friday's session. So we've got a breakout. Now we're looking at a pullback into the US session. The moving average is acting as support. We see Asia break out. Now again, short traders may have taken this trade in the London session. But what's great now that we have this, so once London started trading, okay, what we do have now for Asia is the US session is we have a high range for the day, and we've got a low range for the day. So we've had a breakout, we've had a pullback into the US Open. So as the US market opens, which is right here, early session, then the market opens. Again, payrolls was the doji. Aggressive traders would have entered on that doji, had the long on the doji with a stop underneath. Or again, we're clearly building up inside of the moving average again, underneath of a high, and that market strongly traded back up to retest the high from Thursday. So again, you've seen a couple of things. We haven't gone against the moving average, something I learned from Al Brooks. The market will keep doing what it's been trying to do. Now on Monday and into early Tuesday, we did not have a clear direction of bias into the early part of Tuesday, but once the short trade failed and we had the breakout bar on Tuesday in the London session, traders now saw the emergence of the bulls into the market. So we had one leg up, went into a trading range on the Wednesday. Overnight US session closed out, building up pressure into the highs of Monday. The market broke out strongly. An explosive move like this that doesn't pull back much further, and then again builds up going into the US session with payrolls. You've got to be looking for this price action activity that's going to possibly give another leg of this bullish move. So opening range traders, look for rectangles 8 to 12 hours or 8 to 12 days or 8 to 12 weeks, whatever time frame you're trading. Read Peter Brandt's material on breakout trading. If you want to catch some of the big moves, you've got to be able to somehow position yourself into these trades. If you're looking at other ways to add better ways to make more from your winning trades and lose less from your losing trades, start identifying these key points. Asia close, London open, the US market opens, the London close, looking for measured ranges for profit taking. And again, just keeping simple price action activity, sticking to a consistent pattern with your trading and managing the downside. So hopefully you got some value out of today's video, traders. Keep it simple. Start drawing these rectangles. Don't chase the market. The market is going to keep doing these same things over and over again. Doesn't matter what pair you look at. You can look at the Japanese yen. Every day there's a rectangle somewhere. The market opens up. There's usually a high and a low from the previous day. Look at specific times. You've got the Asia close. We had an inside bar at the London Open. Bang, huge move. Again, traders may pile themselves into these trades until they reach previous levels of support or resistance. But keep it simple, traders. Wait till the market gives you a trading range. Let it build up some pressure. Let it establish the levels that you can trade from, and manage the downside. So hopefully you got some value, traders. Keep it simple. Keep it duplicatable. Manage the downside, and may the markets go with you. Have a great trading week. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.